Mike Wise with CMG Home Loans and your weekly mortgage update. It's been a pretty quiet week this week as far as interest rates are concerned. Hope you're enjoying March Madness. It's coming to an end here this weekend. We'll find out who the Final Four is. So anyways, in the mortgage world, let's take a look at what's happened in the mortgage world. So basically, after a few weeks of just really kind of dropping interest rates, they kind of petered out, they stalled out here. We're still well below 7%. We're in the sixes, 6.5% to 7% as far as the interest rates are concerned. But at the end of the day, we're not seeing the mortgage rates drop too much further, too much faster at this point in time. But what we did see was in February, let me get my pen working here. In February, we got the existing home sales. It was a little bit surprising because December and January were on the low side. We thought February would probably stall out, but with the increased inventory, so inventory went up, mortgage rates come down a little bit, that kind of perked up the market a little bit and got it going. And so that was good. So the existing home sales, you can see, were on the rise there. So that is good news there. The NAR, National Association of Realtors, raised their forecasts a little bit. So they basically went up to 6% growth in 2025. That was a little bit lower than that before. And in 2026, they went up to 11% for the next year, existing home sales. So that is good news. You know, every positive news we can get is good news here. So the national Case-Shiller housing index, it went up 0.6%. So again, good news. We're starting to see the month-over-month growth there. This is a little bit different look at kind of the market. It's a little bit deeper dive into the market. So that's good news there. Let's see here, 25% tariffs. Tariffs were announced, more tariffs, which is, you know, it's a little bit alarming to the market. It's the question here is how is that going to impact? And this week specifically was in regards to autos, and that is, you know, it's going to slow down the auto sales a little bit. It's going to increase the prices a little bit. At the end of the day, this may help the bond market because it may slow down the economy a little bit, which will bring down the interest rates. So we'll see what happens here with the tariffs and how that works out, and and how those go into play. But at the end of the day, it looks like a slower market right now. It looks like things are going to have to slow down before they speed up. And then rents were down a little bit year over year. I would say that the market here for rents, this is a big piece of inflation. So the number of rental units across the nation has gone up, and the amount of vacancies has gone up as well. So what that's gonna do is gonna drop prices, and if prices drop, that means that inflation numbers are coming down. We know that the housing market is a big piece of inflation, and so this will eventually help the inflation numbers start to come down. So pending home sales, they climbed 2% month over month, so that's a good sign there. And then let's see here. There's the Portland. We're gonna go down here to median price income. So basically, this is a chart that's a little bit scary, and I don't want you to get scared of it. But basically, the median home price is about $459,000. 60% of households are unable to afford a $300,000 home right now. So that's due to interest rates. It's a little bit scary, but at the end of the day, we're helping people get into houses. But this is the housing prices, especially here in the Conejo Valley, Ventura area. I think the median home price for Thousand Oaks went up to almost $1 million here last month. So that is, you know, it's getting up there. Like I said, interest rates 6.8% on a 30-year fixed rate loan. A year ago, we were at 6.9. So that slow moving kind of process going down is kind of where we're at. FOMC meetings, May and June, the probability of them reducing the Fed funds rate 88% and 59%, or I'm sorry, 34%, is kind of where we stand right there as far as no changes in the Fed funds rate. So we do think that they are going to reduce the Fed funds rate here. But I think that what you're going to be looking at is not the Fed funds rate, but how the Fed is reinvesting the runoff in their portfolio. So if they start reinvesting those and buying bonds, that's going to bring more buyers, or big buyers as far as the government, to the bond market, and we will see interest rates drop as a result of that. So watch for that. That's kind of the biggest news here that we're going to be looking at today. The PCE numbers came out, the core inflation. They were up just a little bit. A couple of things here we'll go over here. It was the incomes went up by 0.8%, which was above the 0.4% estimates there. And consumer spending was up 0.4%, which was, we were expecting a 0.5%. So that was not as good as expected. But at the end of the day, the inflation numbers, like I said, I think we're kind of under control here, but we will see what happens going forward here. Only time will tell there. So how is that affecting the mortgage market? Well, this morning, these are the actual numbers as of right now. The 30-year bond is up 15 basis points, which is good news. And you can see that it's hitting this 25-day moving average. So it's kind of bumping right up against that 25-day moving average. We were below it. We've kind of crossed the line. That's why I'm saying the mortgage rates, they've kind of petered out. They've stalled out here. And they're maybe starting to come back a little bit this morning. The 10-year yield is down 9 basis points, that's actually real good there. Let me go back to the 3-month and show you. And so we went down below. Right in here, we went down below the 25-day moving average. So we may get down to the 200-day moving average, which is just a slightly lower there, and maybe get down to, this is what we call a Fibonacci level down here. This is a resistance level of 4.12. So right now we're seeing interest rates at 4.27, which is down 9 basis points. That's a pretty big move in the market. So interest rates today are slightly better. Wanted to finish with my all-in-one loan and show you just, as far as interest rates are concerned, I think interest rates, they're going to be maybe between 6 to 7% for the next foreseeable future. So I don't see them going below 6%. At the end of the day, you can get an all-in-one loan. The all-in-one loan is where you pay off your loan in half the amount of time as a 30-year fixed. In this example, I showed where you're saving $646,000. That is a big, that's based on cash flow going through a checking account. And if you do this, the interest rates, we're going to go back one more time here and go to the pay down summary. This is how you can get an effective rate of interest of 3.72%. And that's because you're putting money through your checking account, paying down your mortgage, which is a line of credit, daily interest. And if you do that with the amount of money that I showed on this example, which was about $25,000 per month going through your account, you will see your pay down of your loan super fast. You pay it off in 13 and a half years, and you'll pay $600,000 less in interest, which will give you an effective rate of interest at 3.7%. So I know that was a lot regarding the all-in-one loan, but I love this product. I think that it's an amazing product, and I think that it will improve your net worth over time and help you pay off your home loan faster, giving you the flexibility to invest in the future. So hope you have a great week. I will be around all weekend, so you can call me, text me, send me an email, whatever you need. I will be around to answer any questions that you might have. Look forward to seeing you next week. Bye-bye.